91 million Americans used Buy Now, Pay Later last year. 4 interest-free payments, no big deal, right? Except starting this year, those 4 little payments started showing up on your credit report, quietly, without most people noticing. And nearly half of everyone using it has already paid late at least once. Quick heads up, this is my personal research, not financial advice. Today, what Buy Now, Pay Later actually is, why it felt completely risk-free for years, the one change in 2026 that just ended that, and the real math on what a late payment costs you now. Plus, how to use it without it using you. Let's get into it. First, the basics. Buy Now, Pay Later, Affirm, Klarna, Afterpay, lets you split a purchase into 4 payments, usually 25% up front, then 3 more every 2 weeks. 0 interest in most cases. The average loan is small, around $135. Doesn't sound like debt, feels like a checkout button. And it exploded. The US market hit roughly $70 billion in 2025. Globally, over $560 billion. Why? Because for the merchant, it works. Bigger carts, 30 to 50% higher on average, fewer abandoned checkouts, and access to younger shoppers who don't want a credit card. Retailers pay a fee of 3 to 9.5% to the BNPL company for that privilege. Everyone in the transaction wins, except sometimes you. Here's the part that made this so seductive for so long. For years, these loans were basically invisible. They didn't show up on your credit report. Miss a payment? Often nothing happened to your score. Pay 4 things off at once on 4 different apps? Nobody was tracking your total exposure, not even you. Researchers have a name for this, phantom debt. Because most BNPL balances never touched your FICO score, an entire layer of your financial life was invisible to lenders, and often to yourself. Stack 5 little loans across 3 apps, and you can owe hundreds of dollars you're not really tracking, because nothing forced you to. That changed this year. FICO built Buy Now, Pay Later data directly into its newest scoring models. Equifax and TransUnion now accept it. Experian built a dedicated BNPL bureau, and Affirm already reports to the bureaus directly. The blind spot the entire industry was built on is closing. If you treated these loans as not really credit, that assumption stopped being safe this year. And here's why that timing matters so much. Late payments on BNPL loans have climbed every single year since 2024. 34%, then 41%, now approaching 47% of users paying late at least once a year. Almost half. And for the first time, that number can now follow you. Quick pause. This channel is brand new, and if this is helping you, the single biggest thing you can do to support it costs nothing. Hit subscribe. Here's my end of the deal. 1 video like this every week, no hype, no upsells, just the research. That's the promise. Okay, back to it. Let's do the actual math, because just a small late fee is doing a lot of hiding. The average BNPL late fee is about $10. Sounds tiny, but on a typical $150 installment, that's 6.7% in 6 weeks. Annualize that and it beats the interest rate on most credit cards. A 0% interest-free loan can quietly become one of the most expensive debts you carry, the moment you're late once. And it's not evenly spread. The heaviest users skew low to middle income, younger, and disproportionately Black and Hispanic households, per Federal Reserve data. Deep subprime borrowers, credit scores under 580, made up 45% of BNPL loans in recent years. 21% of users say it's the only payment option they had available at checkout. This isn't just a convenience trend. For a meaningful slice of users, it's a financial necessity wearing a convenience costume. Here's the domino most people don't see coming. A Consumer Reports study found that roughly 1 in 4 BNPL users missed at least 1 payment, and most of those missed payments triggered an overdraft fee on the linked bank account, on top of the BNPL late fee itself. 1 missed automatic payment, 2 separate fees. That's the trap closing, not opening. Now, and this matters for an honest video, the data isn't uniformly damning. The Richmond Fed found no clear evidence BNPL is causing a debt crisis. Even deep subprime borrowers still repay these loans about 96%. In the flip side of the new FICO rules, on-time BNPL payments may start helping thin-file borrowers build credit for the first time. People who've never had a credit card or loan finally get to show up as reliable. FICO's own early testing found users with several Affirm loans, paid on time, saw scores hold steady or improve. So the same change that adds risk for late payers adds opportunity for on-time ones. So the real question isn't, is buy now, pay later evil? It's, are you the person these numbers protect or the person they catch? And that comes down to one habit. Do you actually track what you owe across every app? Or are you trusting the checkout screen to remember for you? Here's the fix, concretely. Most BNPL apps only show you the next payment, $25 due Thursday. They don't show your full obligation across every provider. Pull up every BNPL app you have right now and add up every remaining installment. Most people find 60 to 90 days of stacked payments they'd genuinely forgotten about. If you're juggling more than one, prioritize by interest, not by size. Klarna's classic Pay in 4 is usually 0%. Some Affirm plans charge real interest, sometimes over 30% APR. A small Affirm balance at 30% can cost you more than a bigger interest-free Klarna balance. Pay down whichever one is actually charging you money first. One tactical tip most people don't know. If a payment looks like it's going to fail, don't just wait for the missed payment fee. Canceling or flagging an issue about 48 hours before the due date often forces a manual review and can waive the fee or catch a billing error before it hits. Waiting until after a miss is almost always the more expensive path. Here's the honest test I'd apply before clicking Pay in 4 on anything. Would you still buy this if you had to pay the full price today, right now, from your checking account? If yes, the split is just a convenience, and it's probably fine. If the honest answer is no, that's not a payment plan. That's a signal you can't actually afford it yet. And that's really the core danger of all this, not the fees, not even the credit score. It's psychological. 4 small payments feel nothing like one big bill, even though the math is identical. Retailers know this. That's precisely why average order values jump 30 to 50% when BNPL is offered at checkout. The product isn't the interest-free split. The product is making debt feel invisible. None of this means never use it. Use deliberately, one purchase, tracked, paid on time, genuinely interest-free, it's a mild convenience. Used as a coping mechanism for 5 stacked purchases you can't otherwise afford, it's quietly becoming exactly what a credit card is, minus the plastic, plus the illusion that it isn't debt. The honest fine print. Rules are still shifting. Not every provider reports to every bureau yet. Some rules on interest and disclosures are still evolving. An exact impact on your personal score depends on the specific FICO model your lender uses. Treat everything here as the current picture, not a permanent one. This space is changing fast. So, the final verdict. Buy now, pay later isn't inherently good or bad. It's neutral math wearing a friendly checkout button. The danger was never the 0% interest. It was the invisibility. That invisibility is disappearing in 2026, whether you're ready or not. So get ahead of it. Know your real total across every app, pay the interest-bearing ones first, and ask yourself the full price test before you click. Handled that way, it's a tool. Handled on autopilot, it's the next quiet way people end up in debt they never meant to take on. Enough planning. Open the account this week, set up that first automatic investment, even if it's $25, and let the machine start running. Future you is going to be very, very grateful. Thanks for watching. Stay calm, stay invested, and remember, the market rewards patience. The Koala knows. See you in the next one. Your Finance Koala.